Welcome back to my channel. What is the difference between LTD and LLC? LTD is an abbreviation for limited, which is a type of business structure used in many countries, including the United Kingdom, Canada, and Australia. A limited company is a separate legal entity from its owners, meaning that it can enter into contracts, sue and be sued, and own assets in its own name. The owners of a limited company are known as shareholders and are typically not liable for the company's debts beyond the amount of money they have invested in the company, i.e., their share capital. One of the key characteristics of a limited company is that the liability of its shareholders is limited to the amount of money they have invested in the company. This is known as limited liability. This means that the shareholders are not personally responsible for the company's debts or liabilities. This is a major advantage of the limited company structure as it helps to protect the personal assets of the shareholders from the risks associated with running a business. Another characteristic of a limited company is that it is a separate legal entity from its owners. This means that it can enter into contracts, sue and be sued, and own assets in its own name. This allows the company to conduct business operations independently of its shareholders and makes it easier for the company to raise capital by issuing shares to investors. In addition to these characteristics, limited companies are also subject to certain legal and regulatory requirements. For example, they are required to file annual financial statements, hold annual shareholder meetings, and appoint directors to manage the company's affairs. These requirements help to promote transparency and accountability, which are important for protecting the interests of shareholders and other stakeholders. LLC stands for Limited Liability Company, which is a type of business structure used in the United States. An LLC is a hybrid business structure that combines the personal asset protection of a corporation with the tax benefits of a partnership or sole proprietorship. Like a limited company, the owners of an LLC are not personally liable for the company's debts or liabilities. However, unlike a limited company, an LLC is not a separate legal entity from its owners. Instead, it is considered a pass-through entity for tax purposes, which means that the business income is passed through to the owners, who are then taxed on their personal tax returns. One of the key differences between LLCs and limited companies is that LLCs are not considered as separate legal entity from its owners while limited companies are. This means that the personal assets of the owners of an LLC are protected from the liabilities of the company, but their personal assets are not completely separated from the company's assets. In a limited company, shareholders are not personally liable for the company's debts, which means that their personal assets are protected from the company's liabilities. Another difference is that LLCs are pass-through entities for tax purposes, which means that the business income is passed through to the owners and they are taxed on their personal tax returns. Limited companies are taxed separately from their shareholders, which means that the company is required to file its own tax return and pay taxes on its profits. This can be a disadvantage for some shareholders as it can lead to double taxation. LLCs are also generally easier to set up and less formal than limited companies. LLCs do not have to hold regular meetings, appoint directors, or file annual reports, which makes it easier to manage and maintain. Limited companies, on the other hand, are subject to more formalities.